Hello and welcome to No Ordinary Wednesday, an Investec podcast where we step back from the noise to examine the forces shaping the global economy. I'm Jeremy Max. Now, one area where those forces are clearly at play is private equity, which involves investing in businesses that are not listed on the stock exchange. Now, instead of buying shares on the JSE, private equity firms raise money from large investors such as pension funds and insurers, pool that capital into a fund and use it to buy significant stakes in companies, often taking control. But this isn't passive investing. Private equity investors work closely with management to improve the business, whether that's refining strategy, expanding into new markets, improving operations, or restructuring debt. And the aim is simple: grow the value of the company over several years and then sell it at a profit. But in recent years, that model has been under pressure. After COVID, after the pandemic, growth slowed, interest rates rose, and borrowing became more expensive. At the same time, fewer buyers were active and stock markets were volatile, and that made it harder to exit investments. Funds that expected a straightforward buy, grow, and sell cycle often had to hold businesses for longer. Now it seems that environment is shifting again. Interest rate cycles are turning, capital is becoming more selective, and in South Africa, greater political stability and tighter inflation management are improving investor sentiment. So what does this moment then mean for private equity? Is it a return to financial engineering, or is it operational discipline, which is still the real driver of returns? And why are global and Pan-African funds looking at South Africa again? Lots to talk about. And to discuss this, I'm joined now by Rishanth Pillay, Head of Sponsor Leveraged Finance at Investec Corporate and Investment Banking. Rishanth, a very warm welcome to No Ordinary Wednesday. Let me start with this. When people talk about big turning points in private equity, they often go back to the 2008 financial crisis. But you believe COVID was the real game changer. Why do you say that?
That's a good question. 2008 was highly pivotal for not just South Africa, but globally. For me, working the last few years, 2019 is a lot more relatable and more recent. When you look at companies globally in 2008, when it was hit, there were businesses with fundamentals within them, and those businesses didn't necessarily go under. There were some businesses that were affected because they were either over-levered, heightened interest rates at the time, ended up resulting in companies going under. And there was also a freeze on access to liquidity, and that was the big issue. During COVID, it wasn't just one company or certain companies that were hit. It was everyone. And so, COVID actually pointed out who had pure fundamentals behind them in terms of how they operated, with guys who were susceptible to issues that arose from COVID. If you look at COVID happened at a pivotal time because there were a lot of private equity funds that had just started up their funds, and private equity funds have a finite time period in which to deploy capital. Deployment of capital or realization of returns was effectively hampered by no growth in assets for a couple of years, or stunted growth at least.
So let's move on now from 2019, and that seems such a long time ago. So 2008 was even longer than that. But let me ask you if we're moving into a genuinely new investment cycle, or do you think maybe the sector, the industry, is still dealing with the after effects of what happened during the pandemic?
Yeah, so maybe let's deal with the second point first, and that I think the market is still being hampered by the after effects of COVID. And that's purely as a result of, private equity funds and the respective people around there would have looked at investment cases at the time with, a view as to growth and what those assets would look like in a few years' time. That growth was effectively stunted, and private equity funds effectively need to enter an asset and exit an asset and provide a return. And in order to provide the return, those assets should have grown during that period. And so that escalation to that exit of a growth point was effectively halted, and that's led to less activity. Now, if we talk about whether we're entering into a new investment cycle, just from a macroeconomic perspective, we are very excited about what we're seeing in the market, but also what is effectively a pivotal turning point in terms of how private equity funds deploy in South Africa. There are a lot of large-scale private equity funds who've raised new funds and need to deploy. And that's combined with emerging fund managers who, those are even more exciting. They're new entrants into the market, make the space even more exciting because of the enhanced activity at the end of the day. Banks love that, more deal flow. But I think just from a pure macroeconomic perspective, it's great to see that there's deployment of capital, encouragement of wanting to deploy investment capital into the country, and thereby growing jobs at the same time.
So let's hone in then on the current macroeconomic environment, if we can. I don't need to tell you, we see and continue to see a lot of global uncertainty, investors pulling money into the so-called safe havens. At the same time, the big funds still need to deliver growth. So therein lies a challenge. How are international private equity firms then deciding where to put their money right now? Let's mind their thought process a little.
So I think in times of high uncertainty, and our world's a scary place at the moment, but what private equity funds and a lot of large capital allocators are looking for at the end of the day is, can we look through the cycle? What's happening right now is not necessarily going to be present in 3-4 years' time. And large capital allocators and those who need to provide returns to investors need to be brave enough and need to look through the cycle. And so I think what you're seeing, particularly in North America, Europe, is a shift from pure race behind sector tailwinds to back to private equity fundamentals, which is look for good leaders in certain sectors that you have conviction over. Look for market leaders. Look for good management teams and businesses that are highly cash generative and those that can effectively get through macro headwinds at certain points in the period. And I think that's what you're seeing globally. And that overlaid with, okay, what does the next sectoral tailwind look like? What is the next AI type boom look like? Those are the sectors that guys are effectively looking to reach for, but in the interim are looking for sectors that are feeding into fundamentals of private equity. That overlaid with growth stories. So where can they find growth? So looking at countries and regions where there is growth, particularly in emerging markets, even though everyone's saying people are looking for safe havens. There's no real safe haven at this time of global investment. And so guys are moving again to looking at, the East, looking at India, looking at the Middle East, looking at Africa again. And that's highly encouraging.
I do like that phrase, looking through the cycle. So let's bring it home if we can. South Africa has faced and continues to face deep structural challenges. I think that is a given. But we are seeing signs of greater stability. So are you seeing that translate into more deals actually getting done and maybe an increase in investor interest?
Deals is a key word for banks. What's been highly encouraging is the last few years have been hard. And I think that's both from a private equity perspective, but those of us in the market who are trying to support those sort of players, it's not been an easy place. What we've seen, particularly in the last 12 months, and which I think is going to be a theme going forward, is you're seeing structural tailwinds. So you've got political stability combined with a decreasing interest rate environment. And that coupled with, those green shoots that we're seeing from a macro perspective. And that sort of triangle ends up leading to guys starting to look at the country again. Private equity funds at the end of the day have a finite time period in which to invest. And they need to pick the right time in which to start deploying. I think this is the time now. If you look at the deal volume and the activity in the space over the last 12, 18 months, I think that resonates with the other items that we touched on earlier, which is, new private equity funds having to deploy, new emerging funds coming through. And so those are all highly, highly encouraging for us.
So let me pick you up on that phrase, looking at the countries. That's good news. This might sound like a naive question, but compared to other emerging markets, does South Africa, do you think, maybe have something of an advantage? Maybe because global investors just understand us a little bit better and see us as a little bit more predictable, or is that too simplistic an interpretation?
It's simplistic to an extent, but I think it's resonating quite strongly with potential investors that have reached out. South Africa has been a investment destination for a lot of developed markets, a lot of pockets of capital looking for investment. And South Africa as a country has a rich history in terms of deep capital markets, combined with strong governance structures. There's a lot of reliance on management teams in the private equity space and any investment space. And I think if you look at the quality of people and of, if you just take a look at the listed market and look at the management representation, they're all very, very strong. And that translates into the private capital markets as well. And I think as an investment destination, that is highly encouraging. So, disclosure standards, quality of management teams, deep capital markets, those are all green ticks for investors at the end of the day. And while it might be simplistic, I think it does help a lot that we do have a deep history of being an investable country.
All right, we're going to pick up this fascinating discussion in just a moment with a look at capital structures and artificial intelligence. But first, a quick reminder to subscribe to this podcast if you value smart, informed conversations like this one and want to get regular insights directly from the experts shaping the thinking inside Investec. Just make sure that you follow Investec Focus Radio SA on your podcast app or on YouTube, and that way you will be notified every time a new episode drops. I'm in conversation here on No Ordinary Wednesday with Rishanth Pillay, Head of Sponsor Leveraged Finance at Investec Corporate and Investment Banking. Let's continue the conversation. Now that interest rates are starting to ease, very simply, are you seeing more deals being structured with high leverage again?
So not back to the traditional lever to the hills kind of thing. What we saw over the last few years is a more pragmatic view on leverage. Heightened interest rates meant people took on less debt, and there was more focus on creating operational efficiencies and how to grow the business without the utilization of excessive debt. Through a lowering interest rate environment recently, we've seen a lot more activity in our space. At the end of the day, leverage is a imperative for private equity funds. You need to utilize debt and clever financial structuring in order to enhance return for investors. And that's the name of the game at the end of the day. So we have seen an increase in deal flow.
Which brings me then to a question about private equity's playbook and back to COVID. And I'm wondering whether it's changed for good since the pandemic, or do you think the industry is always going to revert to using financial structuring as that primary driver of returns, obviously when conditions allow?
So let's talk about clever financial engineering and capital optimization. So I think at the end of the day, debt is cheaper than equity. And in order to enhance returns for investors at the end of the day, you're going to need not irresponsible utilization of financing, but clever ways in order to, one, grow the business, and two, enhance and provide returns to your investors. And so the focus over the last few years, particularly internationally, was how do we sweat the asset? How do we create efficiencies? How do we create growth in an industry or a certain sector? And how do we consolidate? And that has started shifting slowly but steadily back towards the utilization of leverage. And it's a cyclical thing at the end of the day. It's never constant. It's never going to be debt to your eyeballs just to be able to close on a transaction. It's the smart use of financing to be able to close transactions, because at the end of the day, if you are not being responsible in that regard, you are likely not going to get further investors coming to you later on.
I've got to ask the AI question now.
Ooh, right.
Here we go. We've seen huge advances in artificial intelligence over the past couple of years. Maybe tell me from a practical point of view how private equity firms are using AI inside the companies they own. And I wonder if it's making any difference at all in South Africa, or, as with so many other sectors, it's largely experimental at this point.
Internationally, it is a massive topic of focus. There are a couple of reports around focusing on how private equity is utilizing AI. It is almost a given. If you are not embracing AI, and particularly internationally in private equity, then you are lagging your competitors. Private equity, particularly Europe, North America, have been utilizing AI to create efficiencies at the end of the day. Efficiency is the name of the game in private equity. And so they're utilizing it all the way from pure due diligence to canvassing of information to synthesizing of information and its analytics that effectively give you outputs that you can utilize in terms of asset screening, amongst a number of other utilizations. The GPs are using it for marketing and other uses that give them a lot more ability to focus on other areas and therefore freeing up their time. The context of SA, themes in international, not just private equity, but in developed markets tend to filter through to SA. Typically later on, a couple of phone calls before this to some of our private equity colleagues, they've indicated that, that slow migration of themes to SA has been accelerated over the last 12, 18 months. So I think it is being embraced in SA, but I think it is going to be the more we can utilize it both from our perspective as well as theirs. It's going to be highly beneficial, not just for deal flow, but for the creation of opportunities later on.
All right, Rishant, let's throw forward, if we can, to the next 12, maybe 24 months. What do you think might derail improving the momentum that you've been talking about? And what do you see as the most attractive opportunities?
The structural tailwinds that we talked about earlier. So, political stability, lowered interest rates, macro tailwinds, those can be hampered quite quickly. And I think we all know the reasons behind that. We've got elections coming up, regional, not national. We've got a inflation targeting regime, and whether that's achievable in the short term is a question that we all need to ask. And what could lead to, again, a heightened interest rate environment, which could potentially hamper one, investment, and two, spending. So those are the types of elements that very quickly change tailwinds into headwinds. And so I think particularly over the next 12, 18, maybe 24 months, those are the most important factors.
And just finally then, one big structural trend that's going to define private equity this year?
Structural trends, I think, for private equity is going to be the clever utilization of financial structuring, as we talked about earlier, because what it allows all parties to do, it allows the bigger players to participate in the market in a clever way, but it also makes the market more highly competitive as a result of the emerging fund managers coming into the space and being able to utilize clever financing in order to compete with some of the larger players on assets that are up for grabs. So I think the move, not the complete move from operational efficiencies to clever financial structuring, but I think a gradual move and a deliberate utilization of that financing is going to be a structural theme together with hybrid equity instruments, which is effectively going to promote deal activity in the space. And I think that's going to be one of the large structural trends.
All right, let me try and sum this up very quickly then. Private equity, I think, as you've just heard, is not operating in a vacuum. It's shaped by the broader environment, the cost of borrowing, political stability, as we've referenced, global risk appetite and investor confidence. I think what we're hearing is that South Africa may be entering a renewed phase for private capital, driven not just by sharper operations, but by smarter use of capital and a more confident global investor base. So Rishant Pillay, Head of Sponsor Leveraged Finance at Investec, thank you for joining us on this episode of No Ordinary Wednesday. And to ensure that you don't miss a show, follow Investec Focus Radio SA wherever you get your podcasts. If you like the channel, please take a moment to rate it, as this is going to help us reach more listeners. Until next time, goodbye from me, Jeremy Maggs, and the entire Focus Radio team.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of the firm and should not be taken as advice or recommendations. Investec Limited and subsidiaries, authorized financial service providers, registered credit providers, and long-term insurer.